right? They told you about the roles of finance manager, right? So I want to just to remind you of that class. Can you please type on the I don't want to encourage the use of your mic, so please mute your mic, everybody, so that the class will not be rowdy. But to record that class, you can just use the chat room to write the roles, the key function, or the key role of a finance manager. Can you use the chat room so that we'll know you have a background knowledge of what you're about to discuss today? Financing decision, all right, investment decision, and dividend. One of those rules indeed. So it is a very critical decision to make, because there's usually a kind of decision a finance manager has to make as to what portion of the net earnings or the profit after tax or the distributable income should be plowed back into the business, and the other portion that should be shared among the shareholders, right? So there needs to be a critical decision to be made by the directors of a company in order to know what portion of the profits that should be back into the may lead to subsequent gain in the future, and which portion should be plowed back. Which portion should be shared among the owners of the business. Don't forget that when I refer to shareholders, I'm also referring to the owners of the business. So, like I said, it is usually a hard decision. In reality, it's a controversial decision, and that has attracted many theories into coming together to look at what dividend policy will look like. Some people posited that dividend policy is one of the hardest decisions, is one of the top 10 difficult decisions in finance, right? And the more we look at it, the more it gets a little bit more simple as to deciding as to how to determine the dividend of shareholders, right? And in determining that, we need to look at the dividend theories, the proponents of dividend theories, right? And don't forget again that the idea of what we are doing here is to maximize shareholders' wealth, right? And although there are two schools of thought here, there is a school of thought that believe that when we declare dividend, it has a direct correlation with the market price or with the share price, right? And don't forget that they are the share price, they are the wealth of the shareholders, and between dividend and the market price of shares, right? So we'll be looking at the two school of thoughts as against each other. Are we together, please? If we are together, just type "we are together" here in the comment section. Good. So let's look at the types of dividend policy. We have two broad, like I underline the word broad. We have two broad theory here. So we have the first one defined as active theory of dividend, and we have the other, which is the residual theory of dividend, right? So the active theory of dividend is saying that in making dividend decisions, right, you would first consider dividend, right, before considering plowing back monies back into the business. Are we together? So what we're saying in essence is that you will first consider the shareholders. So that theory is saying that shareholders gain or shareholders money, distribution to shareholders, is of priority compared to plowing money back into the business. So we are saying that we have to consider the shareholders first before considering plowing back money into the business. That's to show you how active we put shareholders, or how active we put shareholders in our thoughts in distributing income among the shareholders. The second one is the residual theory of dividend, right? The residual theory is saying that, and that is also referred to as the free cash flow theory of dividend. So we are saying that the money that should be shared between the shareholders is after we have engaged in investment. And of course, the investment we are going to be engaging in, we expect that the investment will have net present value. Felix, you raised your hand.
There was a mistake, please. Oh, please. A mistake.
Okay, so the chat room, just I will be able to read from there. All right, so Moses, is that a mistake too? All right, so the residual theory of dividend. The residual theory of dividend is saying that, or is referred to as the free cash flow theory, and that posited that the amount of dividend is simply the cash left after undertaking projects or investments that will yield net present value. The argument for residual theory is saying that by undertaking investment, we are seeking to multiply the profit that should have been distributed to the shareholders initially. Active theory of dividend is saying that we consider the shareholders first, we distribute monies to shareholders before considering taking alternative viable projects. Right, I think that's clear enough, or I hope that's clear enough. So let's look at what are the forms of dividend. The popular form of dividend is payment of shareholders by cash, right? Payment of shareholders by cash. However, we have two other alternatives to the cash payment. Are we together? We have the scrip issue or the bonus issue. Some other persons refer to that as capitalization issue. So it is like we are moving from money, just a simple logic. It's like we are moving money from retained earnings back to share capital. That's what it simply is. Don't forget that when you are doing your CR or your FR class, you were taught that your shareholders funds component is your ordinary share capital, your share premium, and your retained earnings. That's three is we are trying to. So what we are saying is that we are giving shareholders the existing. If you cannot see my screen, I think it should be your network. Please try to correct that from your end. Right. So I was saying that we are trying to move a portion of your income, your retained earnings. We are trying to recapitalize. Recapitalizing means you are trying to change its nature from retained earnings to share capital, right? So it involves capitalization of the reserves, like I've explained. And to achieve that, what you do is that you now give shares to shareholders based on their proportion of shareholding, free of charge. Does it make sense to you? So what we are saying is that now you have 10 shares. We are saying we are giving 2 for 10 shares. So you are giving shares to shareholders based on their proportion of shareholding. So the idea is that we want to increase the share capital and reduce the retained earnings of the company and reduce the reserve of the company. So let's look at the conditions that would warrant, or under which condition can you have scrip issue or bonus issue. The first condition is that the shareholders must agree to having bonus issue. The directors cannot just come and say, okay, we are doing bonus issue at this time. The shareholders must agree, must have a resolution. That's basically when the shareholders are many, you may not have 100%, but at least you must have a reasonable number of shareholders, right? You must have a reasonable number of shareholders who are agreeing to the fact that they want your reserves to change its form to retain earnings, right? The second one is bonus dividend can only be declared once in a year, right? It can only be declared once in a year. The third one is that it's there is a maximum bonus share ratio. So the maximum is 1 for 1 basically, but usually in reality you could have 1 for 5, 1 for 10, but it's simply based on your proportion of shareholdings. But the maximum you can have is 1 share for 1 bonus issue. That's if you have 1 existing share, then you can have 1 other additional share, right? Then all of the original shares must have been fully paid up. Then all original shares must have been fully paid up, right? So all authorized share capital must have changed its form to the paid up capital. Then amount of bonus issue should not exceed the paid up capital, and that's the idea of having a maximum bonus share ratio, so that at the end of the day your bonus issue will not exceed the initial paid up capital that you have, and the company should not be in default of payment of statutory dues to employees and term loans to financial institutions, and that is to guide against financial risk. Anyway, that's to guide against so that we won't. That's to guide against financial risk. I will explain that as we continue the lecture. So that is the idea of script issue or bonus issue. Is that clear, everybody?
Please, can you briefly explain that bonus or script issue again? I did not get. I did not really get it.
We are saying that the idea of bonus issue or script issue is that we are trying to change your reserve, your retained earnings. We are trying to change the form of your retained earnings. Don't forget that the retained earnings belongs to shareholder because it's a component of shareholders fund. Shareholders fund. So we are trying to move a portion of your retained earnings to share capital, and to achieve that, we issue shares to shareholders free of charge at the proportion of their shareholdings, right? Usually at nominal value. Does it make sense?
I get it now.
Right. Any question? Omolara, you are raising your hand. Please, I would. Please mute your mics, everybody.
Right.
You are distracting us with your food, though.
All right. Now let's move then to stock splits or reverse stock splits, right? They've got stock splits or reverse stock splits. So a stock split is an increase in number of outstanding shares through a proportional reduction in the nominal value of share. So now, don't forget that your split issue is like you are trying to move from reserve to retained earnings. What we are trying to do under stock split shares, so the shareholders' total fund remains unaltered, right? But what we are trying to do is to reduce the par value, right, of the outstanding shares. Does it make sense? Sorry, I was trying to say that we are saying that. Are we together, please? Is it clear?
I
I just want to be sure.
I'm
I
with you.
don't understand, though. I don't understand. Let me be honest.
Okay, what I was saying is that for stock splits, what we are trying to do here is, okay, I'll slow down a bit. So a stock split is an increase in the number of outstanding shares, right? And to achieve the increase in the number of outstanding shares, what you want to do is to have a proportional reduction in the nominal value or the par value of a share, right? So in other words, what we are trying to do is increase the number by reducing the value of shares. Do you understand what I'm saying? So at the end of the day, your value remains constant, because don't forget that if we increase the quantity, that's the number of outstanding shares, and the price remains constant, the shareholders fund is expected to increase. But what we want to achieve here is to make the shareholders fund remain constant, right? So two shares, right? And then of the day, the shareholders fund remain constant. Does it make sense?
Yes.
Yeah. So on the other hand, the reverse stock split, we are saying that you are reducing the number of outstanding shares. And don't forget that what we want to achieve here is to make your shareholders fund remain constant. We want to make your shareholders fund remain constant. And don't forget that if we increase the number and the nominal value remains constant, definitely your shareholders fund will increase. But we want to make your shareholders fund remain constant. So the reverse stock split is now trying to reduce the number of outstanding shares, right? And then increase the par value of shares, so that at the end of the day, your shareholders fund remain unaltered. Does it make sense? So we are trying to look at the difference between the stock split and the reverse stock split. So I come again, the stock split is looking at your number of ordinary shares increasing, reducing the par value of shares. Why the reverse stock split is looking at reducing the number of shares and then increasing the par value of shares. But at the end of the day, the shareholders fund remain constant on the two instances. Does it make sense to you?
Very well, sir.
Right on.
Yeah, so let's look at factors affecting dividend policy. Like I said, today's class is going to be very brief. What I just want to achieve today is to build a foundation for the class, because at the end of the day, I still want to do calculation, and I feel it's too early for us to do calculation. So what I need you to do is just to go back to the notes. I may share the notes with you at the end of the class. So you may just want to go back to the notes, just go through the notes, read it again, so that you understand the idea around it, so that in the next class, when we are now looking at the theories and the relevant computations for each theories, then it becomes very clear. So let's look at the factors that affect dividend policy. Number one is obviously the legal constraints. There is regulatory framework that guides the shareholding of each organization, and you cannot do beyond the shareholding. Even, for instance, if you want to do bonus issue, for instance, there is an existing law that says that you cannot do more than once in a year. So the legal constraints poses a kind of restriction on how we can decide on what form of dividend can be paid, for instance. Number two is liquidity and cash flow. Now, you will realize that one of the reasons why shareholders will prefer bonus issue compared to paying cash is because of liquidity. When they declare dividend and they pay same dividend, it's going to affect their cash balance at the end of the day. And when an organization is not liquid enough, right? So what they do instead, because of that liquidity problem, or because of the foreseen liquidity problem that they have, what they do is now to pay shareholders in form of shares instead of cash. So don't forget that there's a tiny line between profitability and liquidity. And the work of finance manager is to find a balance between profitability and liquidity. And at any rate, cash is king, right? You all agree that cash is king. Is that true?
Yes, sir.
Did I just hear no? So
Yes.
liquidity and cash flow determines or is a key determinant in determining what form of dividend will be paid, right? The third one is investment opportunities and growth prospects. Investment opportunities and growth prospects. For instance, don't forget where we came from, the residual approach. The residual approach or the residual theory is saying that we are considering plowing money back into the business, right? So if there is investment opportunity, the finance manager, the directors want to take the residual approach. Meanwhile, if there are no foreseeable investment opportunities that they can undertake, they can take the active approach. So either ways, it depends on the investment opportunity and the growth prospect. Number 4 is to actually manage risk. And manage risk is loan redemption, or if they have outstanding obligation. And there is a form of, if we have, for instance, if we have a debt facility and we consider that our debt to equity ratio is high, or we have high leverage, right? And when there's high leverage, there's financial risk. And once there's financial risk, we are looking at the prospect of paying or settling our debt obligations first before considering shareholders. So that's in a way can actually affect your dividend policies. And then you have internal policies of specific firms. Then you have taxation. Don't forget that in tax planning, for instance, your dividend suffers withholding tax. So you may try to do effective tax planning by trying to retain some portion of your dividend, right? When you retain some portion of your dividend, you are trying to cover from withholding tax. Don't forget that what is assessed to tax is your profit after tax. In a way, I hope you understand what I'm trying to explain here. So there's a relative theory that believes that dividend suffers double taxation. Actually, in reality, that may not be correct. But there's a theory that believes that dividend suffers double taxation. And so for effective tax planning, we may want to retain some monies that should be paid to shareholders as retained earnings and then plow the same money back into the business. So taxation can be something to determine. The next one to consider is the level of inflation. For instance, if you're a shareholder, you'll be looking at your inflation. For instance, in Nigeria, I think inflation is about 34.6% or thereabout. So if inflation is about 34.6, you want to invest or you want to put your money into a portfolio that will give you a kind of returns that is above the inflation rate. Does it make sense? So in that prospect now, you will be considering the level of inflation. And the company or the directors, because looking at the appetite of the shareholders, they want to make policies that will also make sure that they satisfy at least they satisfy the inflation rate. Because in reality, when you want to test how efficient a company is, you want to check that the ROE, that's return on equity, is above the inflation rate. That's to show that, okay, at least if inflation eats up the shareholders' fund, right? I mean, if inflation should affect, at least we know that the shareholders are getting at par with the inflation. Does it make sense to anybody on the call? If you have any question at this point, please feel free to call me back so that I can explain again. So that is that about the level of inflation. And then the next one that looks like it is liquidity preference. Liquidity preference. And the liquidity preference, we are looking at the idea of it's looking at it from the perspective of the shareholders this time. So we are looking at now if the shareholders prefer instant gratification, right? Some shareholders at the AGM just want their money now, right? They prefer now. Why some shareholders look at near term or medium term, or the long term gain. So some may prefer to plow it back, while some may prefer instant gratification, and that depends on the liquidity preference of the shareholders. Don't forget that we've looked at liquidity and cash flow of the company, but this point is looking at it from the perspective of the shareholders. Some shareholders prefer, at least let me know that I've invested and let me get my instant reward now. Does it make sense? Does it make sense?
Sir.
Yeah. Now, let's look at dates associated with dividend payment. Let's look at the dates associated with dividend payment. These dates will be necessary in your computation, so you may want to check out for these dates. The first one is the date in which the shareholders declare dividend, right? And that is called the declaration date. That is called the declaration date. The second date that is of importance is the date share transfer books are to be closed. And that is called the record date. The date share transfer books are to be closed, and that is called the record date. Then the ex-div date. The ex-div date confers, because we have two types of dates. We have the cum-div and ex-div, right? But the ex-div date, when you buy post when you buy your shares at this date, right? That's at the ex-div date. It confers the right to collect dividend on the old owner or seller. So what happens is when you're buying ex-div, what you're buying is your share price is cumulative of dividend, right? Then the payment date, the date dividend checks are mailed out. Actually, that is not what you. So let's look at the theories of dividend, and that this may be where I'll be stopping in the next class. I mean, this may be where I'll be stopping. So let's look at dividend theory. The first one, the theory we're looking at is the dividend relevancy theory. So the dividend relevancy theory is saying that there's I've made reference to this before. He's saying that there's a direct relationship between the dividend policy of a firm and the market value, right? There's a relationship between the dividend policy of a firm and the market value of the firm. And this was proposed by Professor J.E. Water and M.J. Gordon. And we'll be looking at the Gordon growth model, right? In the next few days, in the next few minutes, or no, not today. So let me come again with the date. We are saying that the declaration date, is the date the board of directors announced dividend, right? Are we together?
Yes.
All right. So we say the declaration date is the date the dividend is declared, right? So the record date is the date after. Record date is the date that the share transfer books are closed. So you cannot trade after that date. Actually, that's what it means. The next div date, in reality, is the day after the record date, right? Is a day after the record date. And what that simply means is that you do not have rights to collect dividend after this date. After the record date. Do you understand what I'm talking about? What I'm saying is that let me put some perspective into this thing. Let's say that the record date. Sorry. Let's say that the record date is 31st, or let's say 28th January 2025. Ex-div date, in reality, it's a day after. So that's the next business day, which will likely be 29 January 2025. Right. The implication of this is that any investor who purchased shares after the record date, that is at the ex-div date, will not receive the next dividend that is to be paid by the firm. Is it clear? Is it clear? All right.
It's
So
clear.
the payment date is the date dividend checks are mailed out. The date the dividend shares are mailed out. And actually, if you know these days we don't use checks anyway. So in reality, it's the time that the dividend is paid anyway. So let's come back to our dividend relevancy theory, and we are looking at it that say that there's a direct relationship between the market value and the dividend. There's a direct relationship between dividend and market value. That's what we are saying. There's a direct relationship between dividend and market value. And these two major contributors to this theory is Gordon, that's the proponent of the Gordon growth model, and J.E. Water. So they both argued that shareholders do have a preference for current dividends and that investors are generally risk averse. By risk averse, they don't want to take much risk. So, are we together?
Yes.
So, they do not want to take much risk. And so, for that reason, they attach less risk to current as opposed to future dividends or market gains or capital gains. So, that is their major saying that, okay, the current dividend will affect the long and short of the story is that the current dividend your current dividend policy will affect your market value at the end of the day. So what are the arguments? The first argument they have is called the clientele argument. So we are saying that the nature of your dividend policy attract a specific type of investor. Are you together? So a particular pattern of dividend payment may suit one type of stockholder more than the other. So we are saying that a retiree, for instance, would prefer to invest in a firm that provides a consistently high dividend yield. Meanwhile, a person who is currently on active employment, for instance, will want to avoid dividend, right? So that at least it will reduce withholding tax liability on the dividend. So we are saying that your dividend policy at the end of the day, so if you try as much as possible to declare dividend, you may to declare high dividend, which is necessary, you will likely attract a specific nature of investor, right? So for instance, if we have dividend that declares high dividend, for instance, often, what you would realize is that you are likely going to attract by that high declaration of dividend, likely to be attracting a large number of risk seekers. Meanwhile, if you declare low dividend, if you declare low dividend payout, then you are likely going to be attracting some clients or some of your investors who are going to be risk averse the reward, right? So that's the kind of policy you want to put into play. You have to look at what's the nature of your investors you are trying to attract, and that's the argument for clientele argument. The second one is the taxation argument.
Sorry,
right?
Sorry for interrupting you. Please, can I say something?
Yes.
That clientele argument. What you are trying to say is that different investors with different. Now, there's no specific. Dividend policy for an investor. So the organization should try and an organization should try to look at the class of investors they are dealing with. Am I correct?
Yes.
Yes,
yes, I think what we're trying to say is that, so like at the same time, you know that especially for quoted companies. Quoted companies who are currently trading shares do not have a kind of, how do I put it now? They do not have, they are dealing with a broad-based client. They are dealing with a broad-based investors. So, but at the end of the day, their dividend policy, when you look at their dividend payout history, their dividend payout history will attract a particular kind of investor. That's what I was trying to say. Do you understand?
Okay.
Do you understand my point?
Yeah.
Is it clear?
It's clear.
Okay. So we are saying that at the end of the day, you will realize, because at the end of the day, you will still have, investors can either be institutional or retail investor, and they can either be risk averse or risk seeker. Although there's a school of thought that believes that there's no risk neutral. There's always attention to risk at any point in time. Let's look at the taxation argument. So income in the form of dividend is taxed at a rate different from income in the form of capital gains. So this distortion in the personal tax system can have an impact on investors' preference for current dividends or retained earnings. So if the shareholders' marginal rate of tax were higher than the rate of capital gain tax, you would likely prefer retained earnings for capital growth to current dividends. But in reality, in Nigeria, the capital gain tax is 10%. Returning tax on dividend is 10%. So it's little or not, it really does not make a difference, right? And besides, the capital growth when you put in funds back into the business, when they plow back funds into the business, right? When the fund is reinvested, that's when the return earnings is introduced back into the business. It will likely return. The return earnings will give rise to huge net present value in the future, and when it has huge net present value, the dividend payout should increase relatively. And when that increases, the tax you are trying to avoid you may still end up paying it later. So that, in a way, does not hold, given the Nigerian tax system. That's what I was trying to say. Then the third one is the capital rationing argument. So when a company is fixed with a form of situation where you're trying to place funds, you're trying to share insufficient funds among different valuable projects. The payment of dividends will reduce retained earnings. And when you pay dividend, definitely it affects your liquidity. And what that means is that it even constrains you to undertake a lot more projects. Do you understand what I just explained now? Do you understand the capital rationing argument?
No. The network was bad for some seconds, so I didn't get that.
Okay, what I was trying to say is that capital rationing is saying that capital rationing comes into picture when you are trying to when you have, let's say, 2 million naira and you have alternative projects, and the initial outlay for those alternative projects is about 6 million naira. So it means you do not have much liquidity to invest. You don't have liquid cash to invest. So you are constrained in a way. So paying dividend in such kind of instance will even constrain you the more, because at initial there's liquidity problem. Do you understand what I was trying to say?
Okay. I'm with you.
Yeah. So that's the capital rationing argument. So the next one is asymmetric information. And asymmetric information is saying that there is discrepancy. Don't forget that there's conflict of interest, or there will definitely be conflict of interest between managers and shareholders. There's conflict of interest. Managers want reward, right? Managers want reward, and their reward is coming, or their reward will become more pronounced when there is more profit, right? And there can only be more profit when there is more money reinvested. Meanwhile, shareholders want wealth maximization, right? And wealth maximization may, to an extent, mean that they get their cash, they get return on dividends, they get return on equity, ROE, as early as possible. Now, because of that, there's going to be incomplete information and different information that will be passed out to both manager and shareholders per time. So managers do not know or cannot preempt what shareholders, how shareholders will react to change in dividend. Meanwhile, the shareholders are not party to the information that is available to shareholders that is informing the profit that the business is making at a particular time. Does it make sense? So there is divergence of information. There is different information that is being passed. So shareholders do not know how managers will react, and managers do not know how shareholders will react. Does it make sense? So when managers lack confidence in the firm's ability to generate cash flow in the future, they may keep dividends constant or possibly even reduce the dividends payout. However, when managers have access to information that indicates very good future prospects for the firm, then they are more likely to increase dividend. In fact, in reality, when the board of directors, when members of the board of directors are resigning, it's actually is a negative signal to the shareholders, right? Because in reality, members of the board are privy to more information than the shareholders. Does it make sense? Yeah. The next one we have is signaling properties of dividend. So dividends can be seen to be passing information across. So they pass signals from managers of the enterprise to the shareholders and financial markets. Anyway, in the next class, we'll be looking at signaling properties of dividends, and we're looking at the bed in an argument. Then, by having looked at that, we'll then be looking at some computation in the next class. Do you have any question for me at this point? Yeah, Sharon.
So I'd like to ask, are we still going to get the notes like at the end of this part?
Yes, I will try as much as possible to share the notes. I will try. I'm not promising.
So please do, because like I was in between things during the class, so I wasn't too focused on all of that. So I'd like to like read through, go back and read through these are the things that
No worries, no
I
worries.
actually did today. Thank you
No
very much,
problem.
sir. Thank you, sir.
You're welcome. Abiodun.
Good evening, sir.
Yeah, good evening.
So I just have a question. Is share reconstruction and a reverse stock split the same? Or is there any similarities or differences between them?
That's what we are talking. You mean the stock split? Stock split basically is share reconstruction.
Okay.
That's what it is.
Okay, thank you.
Yes. Welcome. Yes, Ikechukwu.
Okay, sir, I didn't really get the subheading for these arguments. What are the arguments for? Like, are they arguments about what?
I didn't get you.
I meant the arguments. What is the subheading for this
So
clientele?
the argument is actually looking at the argument for the relationship that exists between the share price, right, and this thing, the market value, the dividend and market value of shares. That's what I'm saying. No, what we looked at today is that there is a direct relationship between the share price and dividend policy of an organization. So these are arguments that supports that there's a relationship between the share price and the market value. All right. Another question before we call it a night here.
Yes, sir. Hello, sir.
Yes.
Yes, when you started the class earlier, you were a bit fast. I wanted to ask the forms of dividend. You gave about three. I got two. I didn't get the last one. Payment of shareholder by cash, then capitalization issue, which is the script or bonus issue. I didn't get that
And then the
last
stock
two.
split. Stock split.
Okay, split. Thank you.
All right. Somebody was asking me something. Bonus issue and script issue is the same.
Okay.
All right.
Okay, thank you.
Aremu, you've been disturbing the class. I think you are the one disturbing the class since Abby.
Yes, sir.
Anyway.
Yeah. My question is about the stock split. You said something about reduction in the par value of the company share, which leads to the increase in number of shares, right? I want to get if I'm correct. If a company has a share at a par value of 1 naira and they reduce it to 50 kobo per share, that means any shareholder that has 10 shares, now we have 20, right?
I didn't get your last two sentences.
Okay. Like if a company has a share at 1 naira per share and they reduce the par value to 50 kobo per share, that means any shareholders that has 10 shares will now have 20, right?
Now ask 20. Is that what you said?
Yes, sir.
Yes, that's it.
Oh, okay, great. Thank you, sir.
Another question before we call it a night. Damlola, are you?
Yes, sir. I just want to ask a question concerning the agreement. That capital rationing. I don't know if you can re-explain it.
You know what?
The capital rationing. I don't know if you
Yes.
can re-explain it.
You don't know what? I can't hear you. Can you use the chat room instead?
I don't know if you can re-explain it.
Okay, capital rationing is just like you have. It happens to everybody. It's just naturally scarcity of fund, right? You have 1 million naira and you have 3 projects that you can undertake, and each of them is costing you 500, right? So you just have to manage what you have amongst several projects. That's what capital rationing is basically. Make sense? It happens to everybody. It's just naturally scarcity of fund, right? You have 1 million naira and you have 3 projects. Do you get it?
Yes, sir. Thank you.
All right. If you're on YouTube, I'm with you. Please ask your question. Yeah, I will try as much as possible to slow down my speed. I'm very sorry. I'm very sorry. But hope you got something from this class. I hope you got a little value. Okay. And this class is actually an introductory class. I'm not supposed to rush into some calculations this night so that there won't be a lot of headache. Right. For our YouTube audience, I'm expecting at least a question from You yeah, you can use the chat room. All right. Please respond on YouTube. Yes, I will share. I will share. Esther, I will share the notes. All right. In the absence of question, permit me to call it a night here. So do enjoy the rest of your night.
Thank you. Welcome, sir.